Hey traders, Okane here, and I'm going to show you a strategy called Traders Dynamic Index, which is also the indicator that we're going to use. It consists of a few indicators that we put together in a complex of indicators, as you can see here below my charts. Of course, you don't have to set this up indicator by indicator, but you can download it all and put it up on your charts. You can read the review here at binaryoptions.sock.com first, and if you go down further at the bottom, you will find the Traders Dynamic Index indicator to download and set up on your charts. I will put the link to this article below in the description, so you can go check it out for more info. And let's start by looking at a call option and a put option. So what you want to do is to first try to understand the indicator. There are two blue lines, pretty much similar to a Bollinger Band, and then you have the green line, which is an RSI, and the red line is pretty much like an EMA. So we are trading based on the crossovers. But before we can do that, we have to take notice and focus on this yellow line, which is like a middle band of a Bollinger Band, and we call that the market baseline, and it will identify the trend. So if the slope is going down, price is also falling, slope is going up, then it's time for crossover and wait for the crossover to take a call option. So let's take a look at a couple scenarios. For example, we can see in this area the yellow line is moving upwards, and you can see the RSI, which is the green line here, cross the red line, and it's time for a call option. And as you can see, you could have entered earlier also when the yellow line started to moving up, and you can see the RSI also crossed, so somewhere in this area, and you could again enter a call option. Now let's take a look at a scenario for a put option. At this area, you can see that the yellow line was starting to descend. It was starting to move down, and what you could also figure out later on was the crossover here. The red line is crossed by the green line from above. So the green line is now below the red line. The slope, the yellow line, is moving down. So it's a good time for a put option. So as you can see, the rules are the opposite, but the focus is on the yellow line first. If it's going down, you wait for the red line to get crossed by the green from above, and if it's going up, you wait for the green line to cross the red line from below. So let's talk about expiries. Obviously, as I've mentioned in many strategy reviews before, you want to focus on previous price action. So if you don't know about price action, check out our price action playlist first. What you want to do is to take notice on the candlesticks on each high and low, and figure out approximately what expiry you should use based on previous history on the candlestick, previous history on the highs and lows. So count the candles and use that as expiry. Of course, you could most probably use this on different time frames, this strategy on different time frames. And if you check it out on different time frames, you might notice that on higher time frames you could possibly get lower signals, lower number of signals, but on lower time frames you will get higher rate of signals. So check it out, check out the price action, and take into consideration price action, the breakouts, support, resistance, and the previous history on highs and lows, so you can make the calculations for the expiries on your coming trade. Okay, thanks for watching.